Good afternoon, students. Hope I am audible. Hope we are live. Let me just check once. I think we are. Okay. Let's continue from where we had left in the previous class. If you recall, we were solving the CMA question paper, that is December 2019 attempt, the new syllabus 1, wherein this for the first time started objective type of questions, I believe, in the new scheme. So now we had solved in that first session 26 questions. We will be continuing from there. So now let us look at the 27th question, and let me first read the question and then we'll proceed towards the answer. I think this also we had solved. I'm not so sure. I think not, right? Yeah. So now in this question, what exactly do we have? First let's look at that and then we'll proceed towards the steps. Holding of H Limited was 75% in S Limited. Other information obtained from the books of S Limited whereas under share capital 150 lakhs, everything is in lakhs, that's okay. Then what else do we have? General reserve is there, which is nothing but what? The retained profit. Then surplus statement of profit and loss, that is current year profit is there 35 lakhs, and then we have capital reserve of 10 lakhs. So that is what we have so far. Then if the cost of the investment in shares of S Limited for H Limited was 162 lakh, the amount of cost of control would be dash. Okay, this again is based on consolidation. If you recall, the previous problem was also based on consolidation, wherein we were supposed to calculate the minority interest. Here it is a different step. Okay, let's try to solve this. Let me just bring up something over this so that it's easy for us to okay, now it's fine. I hope both the sections of the video are seen. On one hand we can see the question, I believe. On the other hand we can see the workings. Yeah, fine. If at all there is any problem with the audio or the video, please do let me know, because I won't know unless there is any feedback regarding the same. For now I hope it's fine. Yeah, it looks fine. Now in this case, if you read carefully, the cost of investment is given in the adjustment. The cost of investment is 162 lakhs. That means the company has paid 162 lakh, that is the H company, holding company, paid 162 lakhs to acquire 75% share in S Limited. So now against this 162 lakhs, what is that it has received in return? That is what the question is all about, because they have asked us to calculate the cost of capital. Okay, so now, or rather cost of control. Now against this, obviously we would have received what? The face value of these shares, if 75% is what is acquired. Now look at the structure here of S Limited. We have share capital of 150 lakhs. Now out of this 150 lakhs of share capital, 75% now belongs to H Limited by virtue of acquiring controlling stake. So 150 lakhs into 75%, that would be the controlling stake. Let me just bring up the calculator here. 150 lakhs into 75%, which comes to 112.5 lakhs. So by investing 162 lakhs, the company by way of shares has acquired an interest of 112.5 lakhs. So that is one advantage for by investing in the which is the other company, S Limited. Next, we also have some general reserve. There is some surplus. There is some capital reserve. All these are anyway shareholders funds. Out of these shareholders funds also, the company will get some stake. See, there is one thing which we have to understand. Whenever there is acquisition of one company by another, by investing in more than 50%, we say that company becomes the holding company, the other one becomes the subsidiary company. Now with respect to current year profit and loss account, we have something known as pre-acquisition profit and post-acquisition profit. This pre and post acquisition profits can be calculated accurately only when the date of acquisition is given. If there is no date mentioned, then we'll have to consider everything as the pre-acquisition profit itself. So therefore we are not dividing or splitting the current year surplus, the surplus here, between post and pre-acquisition period. There is no data, so we'll have to just consider everything as pre-acquisition. So how much do we have? 25 in by way of general reserve, 35 by way of P&L, and 10 by way of capital reserve. So when you add all, you will get 70. So 70 lakhs into 75%. So let's do that too. 70 lakhs into 75%, which comes to 52.5. So that means by investing 162 lakhs, we are getting 112.5 lakhs by way of share capital itself and other advantage in the form of 52.5. So let me just subtract that 162 minus 112.5 minus 52.5. So which results in 3 lakhs. Okay. So the benefit has far exceeded the amount which we have invested. So what are the options we have here? Okay, fine. 3 lakhs negative. Once again, we invested only 162, but we got how much benefit? 112.5 plus 52.5. That means we got 165 in return. So if you are getting 165 in return, so what is that we have to call it? It is nothing but the profit which we have got by investing in this company S Limited. But what type of profit is this? It is obviously not revenue profit, because it has got nothing to do with our day-to-day business. So therefore this will be a capital profit, and any capital profit at the end of the day will ultimately go to which account? Capital reserve. So therefore any benefit which a company gets by investing in another company at the time of acquisition, and which will be shown in the consolidated financial statements, will be shown as capital reserve. So in this case, we are getting a benefit of 3 lakhs, just 3 lakhs, but still it's a benefit. But what type of benefit? Capital reserve. So which is the right answer here? Option C. Fairly straightforward problem, I would say. There is nothing much to do here. All that we did was just looked at the capital investment and the capital benefits. The difference was capital reserve. If on the other hand we had invested, instead of 162, let's say 168, in that case we would have invested 3 lakhs more. So that would have actually resulted in goodwill of 3 lakhs, wherein we are actually paying more than what we are getting in return. Of course, the problem is not like that. I'm just telling you another scenario. That's all. Anyway, that is about question number 27. Let's move on to question number 28. So a theoretical question here. Let's see what exactly we have in store. The main purpose of preparation of consolidated statements. It's not consolidate, it's consolidated financial statements. Anyway, institute keeps on making these type of mistakes. So now what is the main purpose? Let us look at the options first. First is the compliance of accounting standard 21, which actually talks about consolidated financial statements. That's correct. To satisfy the legal provision of the Companies Act, okay, to reflect a true and fair view of the position and the profit or loss of the holding group company. That's also true. And the last option being all of the above. So here it's a straightforward question once again. For example, AS 22 refers to what? It's nothing but the accounting standard issued by ICAI. It provides for guidance on the preparation and presentation of consolidated financial statements. So we are actually complying with AS 21. Then with respect to Companies Act provisions, there also we are supposed to prepare the which section is that? I'm not able to recall. You can look it up later. So that is also being satisfied. Then finally, to reflect the true and fair view. See, what is the primary purpose of any financial statement, including the consolidated financial statement? It is to provide the stakeholders or the users of financial information with that information that presents a true and fair view of the financial position and performance of the entity, not just that particular entity, but also the consolidated performance of the group company. Maybe out of one, let's say Tata, for example, Tata Group. Okay, In case of Tata Group, we cannot, let's assume Tata Steel for a second, because Tata Group has many companies. Now, Tata Steel will have its standalone balance sheet or standalone financial statements, and it will have, let's say, 10 different subsidiaries. Now, all of these put together, maybe they're incurring huge losses, whereas Tata Steel on its own probably is making decent profit. But if you only look at Tata Steel's profit, it will not provide the stakeholders a complete information. So we should also look at what the subsidiaries are doing, how are they performing. So when we look at everything, when we zoom out and check, then we'll get a comprehensive idea, right? So that's why this is also important. So therefore the right option in this case would be option D, which is all of the above. So this was a no-brainer actually, very easy question. Let's move on to the next one. Again a theoretical question, but this is slightly outdated, because not because the institute is outdated, but just because this is December 2019 paper. Back then we did not have CARO to 2020. So this is about Companies Auditors Report Order 2016. Now we have CARO 2020, by the way. So was issued by whom? Again, this will not change, because this is still issued by the same organization, that is Ministry of Corporate Affairs of India. Whether it is CARO 2016, CARO 2020, it has been issued by MCA. We can in fact just check the, what is it, our study material. Let me just check. Let's see. CARO will be in this chapter. Companies Auditors Report Order 2020. I hope you can see the material. Ministry of Corporate Affairs, MCA, notifies CARO 2020, which is applicable for audit of financial statements of eligible companies for the financial years commencing on 1st April 2020. Of course, in the question we are talking about 2016 CARO, but here since it's updated, we are looking at 2020, because in the exam you'll get this itself. So as you can see, in the very first line of the study material, they have very clearly mentioned who issues that. It is nothing but, it is none other than MCA. Okay, so that is a fairly easy question to answer. Next, let's move on to the next one. Okay, once again we have one more question related to CARO. So now the question is about applicability, like to whom it is applicable and to whom it is applicable. So let's have a look at that. Let's go back to the PDF, because anyway we'll get to know for whom it is and whom it is not applicable. Where have they mentioned all this? Okay, I'm not able to search that, but let me just look at the options here and then try to answer that. So now if you look at this, which are the options which we have here? So the first option is insurance company. Then we have company registered for charitable purpose and one person company. In fact, this is a very easy question, because CARO is not applicable to any of these organizations. I would suggest please go back to the same source material once the live session is over. You can have a look at it. This option is in fact the correct option, all of the above, because CARO is not applicable to any of these organizations: insurance company, company registered for charitable purpose, nor is it applicable for one person company. So that is the answer. Then again a theoretical question. As per section 149(1) of the Companies Act 2013, the paid up share capital requirement for non-listed company having at least one woman director. Again, this is a fact-based question. In facts-based question, there is no explanation as such. All you have to do is just remember. So according to this provision, you can look it up later on, 149(1) of the Companies Act, for a non-listed company. So when do we say that they should have at least one women director? When the paid up share capital is 100 crores or more. Once again, if yours is a non-listed company and you have a capital, that is paid up capital of 100 crores or more, more than 100 crores or 100 crores also, in such a circumstance, when do we say woman director? In such a circumstance, we actually say at least one woman director should be there, not A, not C, nor D. So the right option is option B. Facts based question, nothing much, you'll have to remember. That's why generally what I suggest students is, at the time when they start the preparation, please mark all those facts when you're reading itself, so that it will be easy for you to revise. Because a day before the exams, you won't be able to go through the entire study material. If you have your own notes where you have jotted down only the facts, dates, numbers, which can be easily asked as MCQ questions, then your job a day before the exam would be much easier. Anyway, let's move on to the next question, which is about the gross value added. Now, what is this? Okay, Sharanya says option B. So that is for this. Yeah, Sharanya is in fact right. Let's move on. Then this is interesting. As per the concept of value added statement, it's about gross value added. Let's see what exactly they've asked. Gross value added is what? That is the question here. Very simple question. They could have asked like this also, what is gross value added? So for that, they have given us few options. Let me just tell you something about the gross value added. See, it represents what? The difference between the say value of goods and services provided by the organization and the value of inputs or resources consumed in the production process. So now how do we calculate this gross value added? It is calculated by deducting the cost of inputs, maybe like raw materials, services, which are obtained from other organizations, from the revenue generated by selling the organization's goods or services. It also includes the value created by organization's own activities as well as value added by its suppliers. What is this gross value added? What does it measure? GVA is a measure of the organization's contribution to the economy, and it is used to assess its economic performance and productivity. It merely provides an indication of the value created by an organization, and it can be helpful in comparison with, let's say, other companies or industry benchmarks. Okay, so now having considered all this, now let us look at the options. Gross value added is what? Distributed to employees in the form of salaries, wages, to government in the form of taxes and duties, to financier in the form of interest. Okay, that is one option. Distributed to government in the form of taxes, duties, to financier in the form of interest, to shareholders in the form of dividend. That is another. Slight changes if you notice. Distributed to employees in the form of salaries and wages, to the government in the form of tax and duties, to financier in the form of interest, fine. Then lastly, distributed to employees in the form of salaries and wages, to government in the form of tax and duties, to financier in the form of interest, to shareholders in the form of dividend, and remaining balance in the form of retained earnings. So in this case, they have given comprehensive explanation actually. So in all the other options, if you notice, one or the other is missing. In option A, something is missing. Option B, something else is missing, and option C also same thing holds good. Whereas in case of option D, everything is covered. Whatever gross value added represents, everything is covered in this one answer. So option D is in fact the right answer. I hope it makes sense. If you have any doubts, please do ask. Next, question number 33. The term calls in arrears is shown in the company's balance sheet. Okay, under current liabilities, definitely not. Under current assets, loans and advances, it's not a current asset. As deducted from called up capital, obviously non-current liabilities is the wrong answer. This is a straightforward question. Calls in arrears, we know what is calls in arrears. Calls in arrears is something which the company has already asked the shareholders to make the payment, but they have not yet received from them. For example, let's say if 10 rupees is the issue price of some company's share, and if the company has already received application money of 3 and now they are supposed to receive allotment money of 4, the company has called upon the shareholders, but maybe some shareholders have not paid this allotment money of 4, then it becomes the calls in arrears. It is nothing but the amount of money that has been called upon a share but has not been paid by the shareholder. This amount is shown in the company's balance sheet, obviously, as a deduction from the called up capital of the company. So therefore option C is in fact the right answer. Okay, so that is about calls in arrears. Next, question number 34. Okay, at the time of forfeiture of shares, the share capital account will be, okay, debited with the paid up. See, here there is one thing which you have to notice. Everything starts with the word debited, so that can also be slightly confusing to the student, but I mean, it's not a very difficult question, by the way. At the time of forfeiture of shares, the share capital account will be debited with the paid up value of share forfeited, debited with the called up value of the shares forfeited, debited with the face value of the shares forfeited, debited with the issue price of the shares forfeited. Okay, let me explain to you with an example. That way it's easier. Let's assume that the issue price is ₹10 and the application price is 3, allotment is 4, and first and final call is 3 again. So in total 10 rupees, no premium, nothing is involved in this. Now some shareholder has paid application money and allotment money also, but ultimately they did not make the payment of call money, first and final call, 3 rupees. Now this shareholder's share is being forfeited. Let's assume that the shareholder has only one share. That means how much is paid by the shareholder? 7 rupees is paid by the shareholder. But how much is called by the company? The company has already called up 10 rupees. That means the company has asked the shareholder to pay entire 10. The moment you ask any shareholder to pay whatever has to be paid, you would have credited your share capital account to that extent. I have already credited share capital to the extent of 10 rupees because I assumed also at the same time that he will pay. That shareholder might pay immediately, but later on only we realized that he is not paying. Later on only we had to forfeit the shares. So now, since we are cancelling those shares, we'll have to cancel to the extent of amount called up. So therefore we will debit share capital because we have to reverse this original credit of share capital, but to what extent? To the extent of called up value, not to the extent of anything else. So therefore in this case option B would be the right answer. Okay, few of you have already answered. Okay, Sharanya says option D, Priyan says option A, but it is in fact option B. Okay, I hope it is clear. If you have any doubts, please do ask. Next, question number 35. Once again a question related to issue of shares, more precisely reissue of forfeited shares. Okay, let's see. Again, this is based on a formula, actually not very difficult. The loss or discount on reissue of forfeited shares may be dash. Again, we know because of section 53 that we cannot issue shares at a discounted price. Now earlier we did not have this rule in the old Companies Act. Correct me if I'm wrong with respect to section numbers. I keep forgetting the section numbers. I think this is because of section 53. That is, you cannot issue shares at a discounted price. Now, loss or discount on reissue of forfeited shares may be equal or exceed the forfeited amount, not exceed the forfeited amount, equal to amount of premium which were received at the time of original issue, not exceed the called up value of the shares. So now, okay, Aniket Rajput has said, he is saying option B is the right answer. Okay, let's see which option is the correct one. So now, when shares are forfeited, the company has an option that we have to understand. What? To reissue the forfeited shares to new shareholders. But sometimes what the company does is, when they reissue, they do not reissue at the same price. They may reissue at a lower price. Okay, so because anyway they have collected some amount, so let us issue at a discounted rate. But this loss or discount cannot exceed the amount which you have already collected. Okay, the forfeited amount or the amount credited to share forfeiture account represents the amount originally paid by the shareholders so far before their shares were forfeited. Okay, so let me give you an example, then then it will be easy to understand. Let's take the same example actually. because anyway we have already discussed this. So the share price is 10 and application is 3, allotment is 4, first and final call 3. He has only paid 7 rupees. That is the called up portion. And now, sorry, called up portion is 10, but paid up portion is 7. So the entry in this case would be debit share capital rupees 10 called up to share forfeiture account rupees 7. Remember, share forfeiture account represents what? The amount which we have collected so far. How much have we collected? Application and allotment only. So therefore 7. And what about the remaining? So that could be calls in arrears, which we thought we will get and which we will not get now because we are cancelling the shares anyway. Now let's assume the same share is reissued now. Okay. So if at all I have to reissue at a discounted price, let's assume for a second that the company is reissuing at rupees 5. Can the company now reissue at rupees 5? So now what is this 5? 5 is the reissue price. So this, how is this related to question? I will explain to you. 10 is the face value minus reissue price of rupees 5. What is the loss here? Rupees 5. Now we are discussing this particular loss. This loss should not exceed this forfeiture value. If it exceeds, then it will be violation of section 53 again. So therefore, option B is in fact the right answer as already pointed out by Aniket. I hope it is clear. If you have any doubts, please do ask. Moving on. Okay, once again we have a question related to forfeiture. Let's see. When the forfeited shares were originally issued at premium, the maximum permissible discount on reissue shall be dash. Okay, slightly different question, not very different from the previous one. But if you have understood the concept in the previous one, then you can easily answer this too. Okay, so let's assume for a second that the share price is 10, plus 2 premium, so 12. Application 3, allotment is 5 or 6, 4 plus 2, then final call is 3. This is how it is structured. Okay, now Aniket says it is option B, amount credited to forfeiture account. Again the same answer. Okay, so here also what changes here? Nothing much. The only thing which is introduced here is the premium part. The only thing introduced here is the premium part. Someone is riding the bike here with loud volume. Just give me a second. Just hoping that fellow will not come back. Okay, so now in this case only the premium has been inserted. Otherwise everything else is same. One thing which you have to understand is securities premium cannot be used for anything other than the 5 purposes mentioned in the Companies Act, section 55 or 51. I always forget this. Check. So now, when that is the case, whatever premium you have collected, let's assume for a second that I will slightly change the situation because the problem is also slightly different. Application money 3 has been collected, but the allotment money has also been collected. Let's assume 6 rupees. And first and final call money is not collected. Okay, not collected. So now the entry would be like this at the time of forfeiture. Share capital account debit. How much? Entire 10 rupees, because again called up money, not the face value, not the issue price, not the paid up also. Then you cannot reverse the securities premium account here, because once you have collected, it's done and dusted. It will belong to that account only. We cannot transfer from that account unless otherwise you are using for one of the 5 purposes mentioned in that section. So no, therefore in this case we'll be simply crediting what? Share forfeiture account to the extent of money we have already received, and to the extent of money which we have not received we'll credit calls in arrears. Once again it will be 7 and 3. How 7? 3 application plus 4 allotment, ignoring the premium part. So that is the important thing here. So now how much is available for us? 7 rupees only with respect to forfeiture. So this 7 can be used to issue the shares again, that is to reissue the shares at a discounted price. Okay, so that means what is the maximum discount which the company can give to the extent of money collected. So what is that money collected? Where is it being shown? It is credited to share forfeiture account. So therefore here also option B is the right answer. I hope it is clear. Again, this is completely based on the logic which we saw in the previous question itself. There is no change. Moving on. We have a practical problem here. Let's read. Z Limited issued 5,000 equity shares. Okay. Yeah, 5,000 equity shares of rupees 10 each at a premium of 10%. Fine. Which is payable on allotment. Premium is payable on allotment. Okay, fine. The company received allotment money. Sorry, the company received application money at rupees 3 per share and allotment money received only on 4,500 as against 5,000 shares which the company has issued at rupees 4 per share. The company forfeited those 500 shares for non-payment of allotment money. At the time of forfeiture, the equity share capital account will be dash dash dash. Okay, so we know equity share capital account at the time of forfeiture will always be debited by the called up amount. We saw in the previous question. No? So now how much is called up? That is the question. That's all. So now if you look at the called up part, let's say how much is called up so far, to the extent of 500 shares, by the way. Okay, 500 into application called up, allotment called up. We haven't even gone to first and final call stage. Company received application money and allotment money received only on 4,500 shares. Correct. So that means these 500 shares, whoever is holding those 500 shares did not pay the allotment money. So application money is how much? At rupees 3 per share. Allotment money is how much? Is rupees 3 once again. How do we get 3 now? We just now saw it is 4. Why am I writing 3? Very simple. All that we need to remember is allotment money also includes some percentage of premium. So what is the percentage of premium? 10%. 10% premium means on 10 rupees, if you calculate 10%, you will get 1 rupee. So if the allotment money according to the problem is 4, it is 3 plus 1, 4. So we are not worried about the premium part here because the question is very simple. At the time of forfeiture, the equity share capital account will be dash. So we are not worried about the securities premium account. Okay. So now application allotment 6 rupees in total. So if it is 6 rupees in total, how many shares are being forfeited now? Oh. Application is 3, right? Securities premium. Okay, let me just write the entry that way it's easy for me. Share capital account debit, securities premium account debit to share forfeiture to call scenarios. Share capital account debit will be 3 plus 3, 6, 6 into 5, 6 5 30, 3,000. Securities premium will be 500 shares into 1, 500 rupees. Share forfeiture account, how much is received for so far? 3 into 500, 1,500. So how much is in arrears? This will be 500 shares into 4 rupees allotment. So this will be 2,000. That's all. This is the entry which we are supposed to pass. Okay, Aniket says 500 shares are being forfeited. 3 plus 3, 6. Correct. Whatever you said is correct, and same is reflected here. Okay, what was the question? The company forfeited 500 shares for non-payment of allotment money. At the time of forfeiture, the equity share capital account will be debited by rupees 3 3,000. Question number 37. The answer is 3,000. Let me just confirm with the guideline answers also. Not that they can be trusted. They say option C. Correct. Fine. I hope it is clear. Let me move on to the next one then. Okay. The capital structure of KC Limited is given. Share capital is there, long-term debt is there, bank overdraft is also there. The average return on similar types of companies is 20%. Fine. While risk-free rate is 10%. Okay, RF basically. Rate of interest charged by the bank is 18%. They're just telling us how much is the bank overdraft rate. Weighted average cost of capital will be dash. Okay, there is one problem here because do we know the cost of equity here? That is the question, right? How to identify that first? Unless we identify that, how can we even consider the weighted average cost of capital? But where is the long-term debt rate given here? The average rate of return on similar types of companies 20%. Okay. That if you consider, then rate of interest charged by bank is okay. Risk-free return is 10%. They say. Weighted average cost of capital. RF we can consider as 10%. There is no beta also, no? How to identify here? Cost of capital is not given. Cost of equity basically. Long-term debt rate is also not given. Am I missing something here? Exactly, beta is also not there. There is some missing information. Let me just check the guideline answers. Let's see if there is any instruction. Sometimes they will tell us where exactly they have gone wrong. They say option D. I wonder how option D. Anyway, I'll just have a look into this later on. Question number 38, so that we can see. I don't think this question is complete. Unless you provide us information, it's difficult to tell what is what here. Okay. Anyway, let's move on to the next one. Question number 39. The difference between company's total market value and capital invested. This is easy actually. So now, what is market value added, you can say? Okay. What is market value added? Market value added is nothing but the difference between company's total market value and the company's capital which is invested, or company's invested capital. That is market value. So I'm just rephrasing the question. Instead of this question, we could have also asked what is market value added. For that, the answer would be the difference between company's total market value and the capital invested. So what does it do? Basically, it is a measure of the value of the company which has been created for its shareholders since the time of its inception. How do we calculate? We calculate it by subtracting the total amount of capital that has been invested in the company from its current market value. If it results in positive market value, then we say the company has actually added value to the shareholders. If it is a negative MVA, then we say the company has destroyed the value for its shareholders. So therefore, we are in fact here talking about the market value added. So which is nothing but market value of the company minus the total capital invested in the company. So that is the thing. Of course, we know what is economic value added. It is different. It's a financial metric, of course, to measure the company's profitability by considering things like cost of capital. You, I'm sure, would have studied EVA. and shareholders value added is again another term used to describe the value created for shareholders, but it is not commonly used in practice. And gross value added is something which you already saw in the 27th or 28th question when we solved that. Anyway, so that was easy. Okay, Priyan has something to say about the previous question. I will have a look at it, Priyan. Anyway, question number 38 is slightly suspect. Next, and there is no instruction in the guideline answers also. I think they think that is the complete information, but beta is not there. Let's see. Okay, Pooja Limited. Okay, they are saying, you are saying that itself is KE. Okay, let's see. Pooja Limited has had the investment of 68 lakhs on 31st March 2018 and that of 81 lakhs as on 31st March 2019. Okay, opening and closing value of investment is given. During the year, the company had sold 30% of its original investment at a profit of 9,60,000. The cash inflow and outflow from the investment will be. Okay, this is a problem based on the cash flow. Let us try to look at the investment, cash inflow and outflow. Let's see. So now, if I have to write the investment account here, so now they say opening balance is how much? 68 lakhs. Investment is obviously an asset and the asset will always have debit balance. So to balance brought down 68 lakhs. Everything is in lakhs. So, and the closing balance according to them is 81. So by balance carried down would be 81. Then during the year, the company had sold 30% of its original investment at a profit of 9,60,000. So 30% of its original investment means 30% of the balance brought down. So how much would that be? 68 lakhs into 30% will be 20.4. Okay. So 20.4 was sold, but it was sold at a profit of 9,60,000. So 20.4 lakhs is the book value of the investment sold, 30%. Plus profit of 9.6 lakhs. So when you do the math, you will get 30 lakhs. No, 30 lakhs is the sale price. We sold investment worth rupees 20.4 at rupees 30 lakhs, resulting in a profit of 9,60,000. So what is the entry when you sell investment? Bank account debit to investment account. Increase in asset debit, which is bank. Decrease in asset credit, which is investment. So therefore, in the investment account, what will we write? By bank. Sale price. So that is 30 lakhs. But the problem here is this 30 lakhs also includes something which is not investment, which is profit of 9,60,000. Any profit in this case will transfer to P&L account. Okay. To profit on sale, just so that we will know what exactly is the position with respect to investment account. So 9.6. That's all. So now we'll try to balance this. So 81 plus 30, 91, 101, 111. So 111 here too. So here from the 111 amount, I will deduct few things. Minus 68 minus 9.6, resulting in 33.4. So what is this? This is the balancing figure. That means the company has purchased fresh investments to the tune of 33.4 lakhs. That means cash inflow is cash outflow is 33.4. Okay. So now cash inflow is how much? The amount which we have sold. The amount which we have sold is 30. I mean, it resulted in increase of cash inflow by 30 lakhs. So cash inflow in this case would be 30 lakhs and cash outflow would be 33.4 lakhs. Which option suggests that inflow is 30 and outflow is 33.4? I hope it makes sense. If you have any doubts, please do ask. Okay, let's move on to the next one then. During the year 2018-19, some company redeemed its 10% debentures of rupees 8 lakh at a premium of 10% premium, and after some time a fresh issue was made of 10% debentures of rupees 7,50,000 at a premium of 25%. The net cash flow from debenture would be dash. Okay, here also we have a question based on the cash flow itself. Let's see how to solve this problem. Okay, It's a very simple straightforward problem. Once again, it's all about math. There is nothing about accounts here actually. So now first of all you have to understand what is redemption. Redemption means when we return the money to the debenture holders. So what is the face value of the debentures being redeemed? 8 lakhs. Okay, but these debentures are not redeemed at face value itself. They are redeemed at 10% premium. That means plus 10%. So 80,000, sorry, 8 lakh into 10% will be 80,000. So we are returning 8 lakhs and 80,000. Okay, that is the amount which we are giving to the debenture holders. Now fresh issue was also made. So what is the fresh issue? 7,50,000. But we did not receive just 7,50,000, we received some premium as well. So 25% premium. 7,50,000 into 25%. 1,87,000. So 7,50,000 plus 1,87,500. So this will be 937,500. 937,500. Let me just confirm. Yeah, 937,500 is what we got. So now outflow is how much? 8,80,000. Inflow is how much? 9,37,500. What is the question all about? The net cash flow from debenture would be how much? So there is some outflow, there is some inflow. So if you remove or if you deduct from the inflow the outflow, you will get the net cash flow. Okay, Sharanya says option C. It looks like that is the option. 937,500 minus 880, which will result in net flow of 57,500. Okay, net cash inflow actually, because we are receiving more compared to what we are giving. So how much more? 57,500. So therefore net cash inflow of 57,500, option C, is in fact the right answer. Let's move on. Okay, so one more theoretical question. Question number 42. In case of financial enterprises, cash flow arising from interest paid should be classified. Grammatically the paper is so horrible. I don't know who sets the paper. In the case of a financial enterprise, or in case of financial enterprises, cash flow arising from interest paid should be classified as operating, investing, or financing, or they have given either option B or C. So first of all we have to understand what is this. Okay, cash flow from operating activities means what? They typically include transactions related to, let's say, the principal revenue producing activities of the company. So for financial enterprises, maybe let's say bank or maybe some other organization which is into lending, interest paid, which is a cost which is directly related to their operating activity, because they are into finance, that is their day-to-day operation. Any interest which they pay as part of their day-to-day operation is their operation activity only. Whereas on the other hand, cash flow from investing activities would usually include what? Transactions involving maybe acquisition of some long-term asset, maybe disposal of long-term asset. So that would be investing activity. Okay, so therefore in this case, or financing activity maybe would include raising of capital, maybe some borrowing, maybe issue of dividend. So we have already eliminated these two. So the right answer in this case would be operating activity, because if it is a financial organization and if they are paying interest, for them it is not a financial activity, but instead it is an operation activity, because it is paid as part of their day-to-day activities. That's it. Okay, let's move on to the next question. Question number 43. Okay, it's a practical question. As you can see, okay, Priyan says option C. I hope you guys were referring to the previous problem. Option A is in fact the right answer for question number 42. Next, question number 43. Balance of provision for taxation as on. Okay, this is again very similar to the one which we solved earlier just now regarding that investment. So here also we have been given the opening balance and the closing balance of provision for taxation, and they also mentioned how much tax was paid. So All that we need to do is calculate the amount of provision for taxation made during the year. That's all. So here also, if you can drop the ledger, it will be easy for you to calculate how much provision is made. For example, provision for taxation. So provision for taxation, by the way, is what? A liability. Okay, and liabilities will always have a credit balance. So bring down the balance first. By balance brought down. How much is the balance? 1/4/2018, 13 lakhs 72,000, and closing balance is 12 lakhs and 5,000. Okay, and closing balance is 14 lakhs and 55,000. During the year, they said 12 lakh 5,000 were paid towards the income tax. So let me just write down the stuff first. 2 balance carried down and 2 bank. Since it was paid, bank account is an asset which is decreasing, so credit that 12 lakh and 5,000. So what is this then? That is nothing but the current year provision. So that would be buying P and L. So now how much is the total here? 60,000. So this will be 26 lakh 60,000. So 26 lakh 60,000 minus 1372, 26.6 minus 13.72. This will be 12 lakhs and 88,000. That is the provision which the company has created, which is option B. I hope it is clear. So the current year provision in this case would be option B. So which is 12 lakhs and 88,000. Very straightforward question. There is nothing much to do here. Moving on. Okay, again there is a problem related to cash flow. Let's see. So original cost of a plant is 1,35,500. Accumulated depreciation is also given. Fine. 72,800. Let me just drink water. Sold at a profit of 15,900 during the year. Okay, amount of cash flow from the transaction would be dash. Again, very easy question, nothing much to do here. So first of all, we have to understand what is the written down value of the asset. If you look at the original cost or purchase price or historical cost, whatever, original cost or the purchase price of the asset is 1,35,500. From that, reduce the accumulated depreciation. That will give us what? The book value of the asset, which is this minus this, 135,500. Sorry, 135,500 minus 72,800. So this brings us to 62,700. This is the return down value of the asset. And this return down value was sold at a profit of 15,900. So plus profit of 15,900 now. 15,900, that means this will be 5, 6, 7, 8, 6, 7, 78,600 would be the sale price of the asset. So the amount of cash flow from the transaction would be 78,600. Fairly straightforward, nothing much. Okay, easy. Okay, Sharanya says option D. In fact, it is correct. Let's move on. Mithu Limited had investment as on 31/3/2018 and 31/3/2019. Once again, cash flow problem. There are many cash flow problems, no? But all of them are actually very easy, not difficult at all. Okay, let's see. So in this case, let me just read the question. Investment. Mithul Limited had the investment as on 31/3/2018 and 31/3/2019 opening and closing. During the year, interest on investment received 77,000, which was used in writing down the book value of the investments. Fine. If there were some purchases of investment, then the cash flow from investment and from interest would be dash and dash. Okay. This is also fairly easy only. Let's see how to solve this. Okay. So in this case, what they have done is they have attached investment with the interest portion. So it is not just investment they are worried about, they are also asking about the interest, which actually makes our life easier. If I were you, and if I had seen the question in the exam, I wouldn't even bother about calculating. I would directly look at the option, because I already know from this sentence, during the year, interest on investment received 77,000. There is some cash flow there only, you know. So now let me just look at the options. Cash flow 1,300 only, obviously wrong. Obviously wrong. Second option also. Third option says cash inflow 77,000. From what? Interest. And cash outflow 64,000. Maybe that is there also, but the moment I see cash inflow, I wouldn't even bother checking the other calculation here, because here also we have a different inflow which is wrong anyway. 77,000 is for sure. We have received that much inflow from investment, so I would simply click or select the option C. That would make our life easier, because sometimes what happens in the exam, you'll have to also look at the options. That will actually reduce the amount of time which you need to solve the questions. So here we can still solve this, but I'm just telling you the shortcuts which you can use in the exam. Anyway, so now if I have to prepare the investment account, to balance brought down, how much is the opening balance? 1095. By balance carried down, investment is an asset, so therefore it will have debit balance. By balance carried down is 10,82,000. We have also received some interest, right? So the entry would be bank account to investment. So by bank here, by bank 77,000. Okay. So now that's all. Okay, so if you do the math, 77, right, plus 1082, 1159. From 1159 deduct 1095, 64,000 is the outflow. Sorry, inflow. Why not in machine is, what is this? Investment is coming in, but cash is going out. Sorry, cash outflow. Cash outflow would be 64k. Cash inflow would be 77k, which we have already selected. I hope that's easy. If you have any doubts, let me know. Next, question number 46. This is about what now? Cash flow from operating activities. Again, a cash flow related problem. Interesting that there are many cash flow related questions here. Okay. Anyway, let's try to solve this too. So in this case, what is that they have asked? From the following information provided by a trading company, net profit after tax is given 18,35,000. During the year 2018-19, so many things have been done. Depreciation written off, goodwill written off, provision made for taxation, income tax paid, interest on investment credited to P&L account, interim dividend paid. Cash flow from operating activities would be. So now there are various ways of dealing with this. Let's try to understand how to do this. Now if you look at this, we have to identify cash flow from operating activities. We can start with net profit after tax. So net profit after tax, for that we can make adjustments regarding the non-cash expenses. How much is the net profit after tax? 18,35,000. Because it is all about cash flow, we don't have to worry about the non-cash expenses. So net profit after tax plus non-cash expenses where cash is not going out at all, okay, minus the net working capital or changes in working capital, both one and the same. So 35,000 is the profit after tax. What are the non-cash expenses which we have before arriving at this? If you look at this, here we have depreciation which is written off, then goodwill which is written off. So that we can add it back because it's anyway non-cash expense. So 1,08,000 plus 1,50,000, which will be 1,58,000. I'm just clubbing both there. Then we can account for the changes in the working capital. So now changes in the working capital means with respect to, let's say, provision for taxation or maybe income tax paid or even interim dividend paid. Okay, so in this case, okay, by the way, what about the interest on investment credited to P&L account? Should we worry about that? Interest on investment. That will not again come, no? Because interest on investment would have been credited already, but that is something which we already received. Depreciation we have considered, goodwill we have considered, we have added it back. Provision for taxation we will consider now because it affects the working capital changes. Then what else is there? Interest is there. Let it be. How does it matter? We'll see if it will affect or not. Then we have to worry about the working capital changes. That's the only thing which is pending now. So now what are those things which changes the working capital? We have provision for taxation. Then we have what else do we have which we are not considering? Income tax paid is there, interim dividend paid is there. Okay, Priyan is saying something. Operating profit since it is trading company. So add 25,000. I didn't get, once again, it's already added, no? It's already considered there. So 18,35,000 is inclusive of this 25,000. So I won't bother touching it if I don't do that, and if I only consider the net working capital changes or changes in working capital. So now provision made was 5,50,000. So it's a non-cash expense. It's a provision. So add it back. 5,50,000 doesn't really change anything. So I'm adding this. Then there is income tax paid. Deduct that. How much is the cash outflow there? 4,80,000. Then there is interim dividend paid. So deduct that to 2,10,000. So when you do this math, how much will you get? 18,35,000 plus 158 plus 550 minus 480 minus 210. 18,53,000. Okay. Is the math correct? Plus 550 minus, let me just check somehow, I feel it's wrong. 1835 plus 158 plus 550 minus 480 minus 210. 1853. We won't get the options, no? Option is not there. Something is wrong somewhere. Okay, I will do one thing. I will start from this question itself in the next session. Question number 46. Why not we can deduct tax paid from provision, says Sharanya. I mean we can still deduct, but it's the same thing. We are still deducting that only, no? So provision, I mean, why not deduct means it's non-cash expenses, so we have to add it back. It's cash is not going out because of that provision. It's only a provision. We are not making the payment. Whereas whatever we have paid, that we have deducted. No, income tax paid, we have deducted 4,80,000. So I think I understood your question correctly. If you have any doubts, please do ask. Anyway, we'll stop here. I'll continue from question number 46 in the next session. Fairly about 50% of the questions are covered so far. Next week also we have a couple of sessions of CMA and couple of sessions of FM. So we'll try to finish this paper at least. Thank you. If you have any doubts with respect to any of the questions which we have solved, please leave a comment below. We will take it up in the next session. Thank you guys. See you. Bye bye.